Welcome back everyone to the Moneycontrol live stream. You're watching markets with Santo and CJ, and bulls have tried to make a comeback in this market after a muted start we saw in the morning. The short covering that I mentioned earlier in the morning has happened, and we have seen a little bit of recovery in the Nifty and Sensex. They're both currently trading quite strong and in the green territory, but the selling pressure clearly is in the mid and small cap space, where we have seen the indices come off lows but not really recover into the green territory. So clearly that is where the weakness in sentiment can be really felt. Apart from that, if you look at some of the stocks that have been helping the Nifty 50 and Sensex, they are the major heavyweights. You have RIL, ICICI Banks and Axis Banks of the world helping out the bulls at this juncture. Santo, clearly the large cap space is moving on, but the mid and small cap space is where the pain is.
Well, you've been spot on in your assessment over the last couple of days, I must say, CJ. Yes, we've seen a fair bit of short covering because of the derivatives expiry. But that said, still, and you mentioned it yourself, the weakness, the pain in mid and small caps is still pretty much evident there, and that is indicating that retail is now beginning to get a little jittery. They are selling into rallies. You're seeing the occasional strength in mid and small caps. However, none of these stocks are sustaining at higher levels. Also, technical analysts are a little concerned because the general view was that if Nifty holds above 15,900, then that's a
that was
key
when
positive.
The 20-day DMA was also
exactly,
there. I mean,
and
good short-term
the
indicator.
market again is not giving any signs that it has underlying strength. Although you're seeing a recovery in the odd index heavyweight, it's still not enough to take the Nifty above 15,900, which is a psychological level that's being closely tracked by traders at this point.
I think, Santo, if you want to surmise today's day, you would want to look at the smaller mid-cap space instead of looking at the Nifty, because Nifty is being optically, looking like a good thing because of the F&O expiry later in the evening that has triggered some short covering. So therefore, if you're looking for the real sentiment, probably the mid and small cap space is a better portrayal of how the market is right now feeling than the Nifty. That said, individual stocks were definitely in action. A lot of bulls on the stocks, a lot of bears on some other stocks. Starting off with Santo.
Gabriel India, well, this is not usually the kind of stocks that I do recommend, but this, when you look at the numbers here, there seems to be some kind of deep value. The stock has been ignored for quite some time now, a small cap stock largely, but the fourth quarter numbers were pretty much strong. Also, Gabriel India is a major player in the shock absorber segment, both in OEMs as well as in the replacement market. In the replacement market, it's got a very fairly strong dominant position there, close to 40% market share, which is quite huge. Now, there are also talks that Gabriel India is in talks with Maruti, for supplying components for their upcoming couple of offers. Besides, it's also close to signing deals with M&M for two of their offerings, one with PSA and one with Volkswagen as well. Besides, being in negotiations with TVS. And then for a lot of electric scooter companies which have taken Gabriel India as their preferred partner. So a lot of things happening for Gabriel at this point in time. And when you look at all this, CJ, you got sales of little over 2,000 crores and the market cap is less than 1,900 crores. That is the biggest argument. It can't, of course, one can say that there are any number of negatives about the stock, but just look at the numbers there, the sales versus market cap, and I think the market seems to have already priced that in.
I think, Santo, one time's price to sales is quite fair for a company where the industry outlook itself
this is
not
less than one time,
little less than one time. I mean, we can just get rounded off to one time sales. That said, I think even if you look at based on FY23 earnings expectations, stock, despite the correction, I think is still quite expensive. Maybe if you reach increase it to FY24 earnings, maybe it starts looking cheaper, 2-year forward earnings, but based on 1-year forward earnings, I think the stock is still quite expensive and there could be more room for correction, and that is why I feel that investors may not look at it very kindly at this juncture. Apart from that, Gabriel India being an auto component player, clearly its fortunes lie in the hand of what happens in the broader automobile sector. And at this point of time, while there is optimism, guarded optimism for the sector, clearly evidence still has to come forth that we are in a new cycle for the automobile sector. We have to wait and see how the June data, that will start trickling in from tomorrow morning. We have to see how that data shows, whether there has been recovery in demand in the rural areas, excuse me, in two-wheelers, in other product segments, I think that will be a very good indicator, and maybe then you can start again relooking at a stock like Gabriel India. But till then, I think it will be better to look at other opportunities which are much more cheaper and much more bigger in size.
Well, CJ, I'll throw one of your favorite lines back at you. If you wait too long, you're going to miss out on opportunities.
I'm just asking to wait 2 days, Santo. I don't think it's that long. That said, one stock where nobody is waiting at this point of time is MCX, the multi-commodity exchange. Well, what an action today after SEBI's approval of allowing FPIs to trade in exchange-traded derivatives, commodity derivatives on the non-agri side only so far. The up move on the stock was quite spectacular. The reasons are quite clear. If FPIs come in, that will boost overall volumes on the exchange, on the commodity derivative exchange. You will see more market participation. Motilal Oswal expects that market depth as well as liquidity on the exchange will improve, and that in the future will also aid price discovery going ahead. So clearly, this was a long-standing demand of the commodity sector, commodity market for a very, very long time. A lot of people have been lobbying the government, the SEBI, to allow FPIs to get into the space. Remember, a lot of domestic institutions are already allowed to participate. You have category 3 AIFs, you have PMSs and mutual funds allowed to participate in the commodity derivative market. But with FPIs coming in, clearly good days ahead for MCS, Santo.
Well, you said a spectacular response by the market. I don't really see that as a spectacular response.
Why not?
2% up is just about...
It has come off its high, Santo. I mean, it was at one point of time, it was higher than 3.5-4%.
Even 4% is quite ordinary for a major announcement like this. You're talking about a major...
In a market like this, 4% is great. I would take it any day.
Look at it this way, it's going to make a, the entry of FPIs is going to make a very big difference to the overall traded turnover on MCX.
Yeah.
The market should have been celebrating it, but it is not. The other point is, CJ, for the last 3 years, despite all the action in global commodity markets, now you can say that COVID affected most companies, but as far as exchanges go, they clearly have been the beneficiaries of COVID, in fact, because traded turnover has really surged, and you've not really seen that in the case of MCX. The earnings have been just about okay last 3 years, no big change. So I don't think the market is pretty excited at this point in time as far as the announcement goes. The second part is that, again, look at the longer term performance of the stock, It's not been a wealth creator, and this despite the fact that everything, it's got very good margins, close to about 44% operating margin. It's a near monopoly player, right?
Yeah.
It's got almost no competition. That being the case, you would have expected a far higher multiple or a better stock performance, none of which are coming through at this point.
I think, Santo, that is down to the fact that turnovers in a commodity derivative like MCX are cyclical, because commodity as a play is always cyclical in the market. I mean, the past 2-3 years, a lot of people had written off commodity stocks. Commodities in general were quite down and out. It's only with the past, after post-COVID, that we have seen an upswing in commodity trading. And if you look at the past 18 months performance, you will see that also reflected in the average daily turnover of the exchange. Before that, clearly the market was not too convinced about, because there were also a lot of regulatory issues that commodity derivative exchanges face, like MCX. You could any day have a futures contract being made invalid because of a government intervention or whatnot.
But so that was mainly for agri commodities, right?
Exactly, and so those sort of commodities also are quite important drivers of volume sometimes on the exchange. So clearly there has been a lot of, what do you call a discount on regulatory actions in this space, and I think that is why probably you have not seen the stock perform that well.
Well, Ipca is the third stock on our watch list today. Now, it's largely a strong play on the growth in domestic formulations business. 43% of Ipca's sales come from that, and in the fourth quarter it did report a very good jump in earnings there, 27% growth in its domestic formulations business. Now, what is probably holding back the stock at this point in time is slight underperformance as far as its API business goes.
Yeah.
Now, the company Devas plant has been partially commissioned. It's not fully operational at this point in time, but according to Moneycontrol Pro, the company will be able to get its plant fully running by August of this year. That should make a big difference to its API business. That said, Ipca has been doing pretty well in the acute therapies segment, be it antibacterial, cough and cold, and also pain management. Now, pain management is almost, it showed a 20% growth in its pain management therapy segment. So right now, there are concerns, no doubt, which is why the stock has been struggling and underperforming, but the company seems to be on its way to rectify those, and that is why you're getting the stock at a fairly reasonable valuation at this point in time. And according to Moneycontrol Pro, the stock is valued at close to about 13 times enterprise value to EBITDA, which, given the challenges and everything considered, it's not asking for too much.
Well, Santo, I'm just surprised to see Ipca Labs on your list, because I would probably be at least 10 steps away from a stock like this at this point of time. Yes, maybe the India business was quite good in the March quarter, but if you look at the overall earnings performance, it was quite bad. I mean, you had seen a lot of brokerages coming out, brokerages like Sheikh Khan coming out and downgrading the stock. Now, clearly the biggest setback for FY23 was the delay in commissioning of the Davis plant. Even if we believe that they can commission the plant, fully commission the plant by August, that's almost 5 to 6 months of volume play you have taken out of the export market, and that itself is going to impact the earnings of FY23. So clearly that delay has hit the prospects of the stock.
August is just 2 months away, my friend.
It is, but you have already taken out 4 to 5 months of the year, right, of the fiscal year, right? So therefore, it will be a tall ask to expect Ipca to make up for all of those 5 months of lost volumes in the next 7 to 12 months, 8 months. Apart from that, the export business itself is not looking quite good for Ipca Labs. It's been struggling ever since the earlier regulatory actions on its plants 3-4 years ago. It has been very much of a struggle in the export business for Ipca Laboratories, and with the Davis plant delay, this plant was expected to turn around the fortunes, but with that delay in commissioning, clearly the export market is not going to provide any help to earnings in FY23. Apart from that, even in the home market, if you look at the institutional and generic market, Sheikh Khan believes that not only Sheikh Khan, actually a lot of analysts in the pharma sector believe that the institutional and generic drug business is facing stress at this point of time. So I would not be so convinced that they'll be able to outperform the market, although the management is guided for a 10 to 12% year-on-year sort of growth in FY23. Lastly, margins. There have been cost increases for API drug makers like Ipca, largely down to the COVID situation in China, and Sheikh Khan does not expect margins to improve in FY23. They expect that the margins will largely remain flat, owing to the higher costs that they face, on the raw or the bulk drugs that you call, or the raw material for the bulk drugs manufacture.
Besides that, they are also investing heavily in growing its field stuff, but that's also a function of the domestic formulations business growing pretty well.
Well, Santo, I put out my reasons why I will stay 10 steps away from Ipca, but why I will stay 10 steps closer to Devyani International is pretty clear. The stock zoomed today after the management indicated ambitions to expand its store chain or retail stores in the country. Today it's a milestone day for Devyani because they have opened their 1,000th store, and the management indicated that they plan to open 1,000 more stores over the next 4 to 5 years going ahead. So clearly this is a big statement coming out from Devyani, Santo, because this shows the confidence that they have in the QSR industry in India. Clearly, recently QSR companies have been under pressure owing to margin concerns, owing to demand concerns because of the current inflationary environment. But overall, if you look at the bigger picture, Devyani is believing in India's story, in the consumption story, and I think we all should back them.
Oh, well, good. The price has been pretty steady in this market, but maybe the market then is not fully pricing in the concerns of an inflationary environment. Besides that, CJ, 100 times trailing earnings, a little too stiff, it's just turned corner recently.
It's a high growth company.
Yeah, it's a high growth company, no doubt, but would I want to pay this kind of valuations in this kind of a market? Maybe I'll give it a pass.
If it doubles or triples your money in 1-2 years, I don't think why would you not want to pay it.
Oh, well, that is playing the momentum game, which I'm not really good at and don't want to master it either. Zydus Life is the last stock on our watch list this afternoon. Again, the company has a promising pipeline of new chemical entities, biosimilars, transdermal and injectables. Now, it's again, CJ, this is a pure valuation play. It's quoting, according to Moneycontrol Pro, it's quoting at a very significant discount compared to some of the multinational pharma companies. Take for instance Abbott. Abbott has got sales of domestic sales of close to a little over 4,000 crores, and it has a market cap of about 38,000 crores. Same is the case with Zydus also. Zydus total revenues is about 15,000 crores, but its market cap is just about 36,000 crores. So it's largely a valuation play as well. if you look at its biosimilars portfolio, you know, about 13 products are account for about 600 crore. That's the kind of size. Now, Zydus is trying to get a market for that overseas as well. It's targeting Latin America, China and Russia. So, if you look at, you know, the company's plans and the fact that it is available at a deep discount, I would say that CJ, this makes for a good bet.
Well, Santo, I totally agree that the valuation gap between Abbott and Zydus does seem a little unfair at this point of time, given that they're both in the same market and also probably category leaders or product leaders in certain segments of the market that they are in. So clearly, there seems to be some point, some truth to the point that you are making. So this will be one stock that even I would be probably watching out for. That said, before we move on, let's quickly just take a status check on the market. And well, we have given away the gains. The Nifty and Sensex have turned to the red. Nifty is down about 0.2%, while the Sensex is just about flat, but in the red territory. The Nifty mid cap has accelerated the losses, down now about 0.9%. It was down about 0.5% when we started off the show, but it's Nifty Bank that is holding steady, and I suspect that is largely due to short covering, because banks were one sector where you had a lot of short build up during the course of the June derivative series. So I would probably not read too much into that at this point of time.
Well, with that, let's quickly move over to our colleague Manisha.
Yeah.
Manisha Gupta. Well, CJ, the falling rupee has been the biggest concern for the market, though I don't think the market is fully grasping the implications of that.
Absolutely, Santo. I mean, yesterday we hit a record low on the rupee, although we ended a little higher or off the day's low, but we still marked another record low on the rupee. And it has been a chaotic year for the forex dealers out there, Manisha. What is the feeling right now? I mean, we have already breached the 79 handle on the dollar rupee. Are we staring at 81, 82? There are some talks of even 84 out there.
Well, I wouldn't go so far as 84, but yes, 80, 81 is something that most banks and brokerages will tell you that it is going to happen. You know, we've done an all-time low of 78.98. So we've been just 2 paisa away from that 79 mark, but the expectation being that that could happen in this week or max next week, and $80 of a rupee could be seen by mid-July. So that is where we are running on to at this point in time. Rupee actually in this week has been one of the worst performing Asian currencies as well. We've seen more than 2% of a decline in rupee in the month of June. We're down by nearly 6% for this year until now. And yes, there could be further declines. All fundamentals that you look at are pointing towards further depreciation in the currency.
Well, Manisha, just forgive CJ there. You know, that is what happens from covering stocks for too long. So you think that, 1 or 3% move in a single day is quite normal. That's why the question whether it's going to go all the way to 84, 85. Well, Manisha, so what does this, the weak rupee, what are the kind of implications that it's going to have for, companies in the oil sector and also in the ferrous sector?
Well, clearly, India imports a lot of raw material, a lot of agriculture commodities as well. There's a lot of travel happening too. So it is going to have an impact on all of that. Last year, same time, we were trading at 67 to a dollar. We've declined to 79 almost, and we have headed further lower. If you look at everything, as I've been saying, whether it is about the fact that the inflation is sustaining, you have the crude prices at 117, 18, and 85% of our crude is imported. So that is imported inflation for us. Another thing that we are seeing into the markets is that importers are buying dollar because they think that the dollar will continue to depreciate, and exporters are not selling dollars because they know that the rupee will continue to depreciate. So they are holding back, and that's exactly the trend that we've seen from state-owned bank buying dollars for oil companies, foreign banks buying dollars for FIIs, and the kind of sell-off, you guys have been talking about it, the kind of sell-off that we've seen from the equities in sense of outflows this year to the tune of $2 billion also says something. And then you have the balance of payments expectation that we're looking at $61 billion of a number in FY23 itself does not augur well. So all indications towards further depreciation. It is going to be quite difficult when you look at all the importing countries, the raw materials that India imports, right, starting from metals to food grains to clothing to gadgets. Everything is going to get expensive because of the kind of rupee that we are staring at.
Well, clearly, Santo, you can't make that US trip anymore. But my last question to you, Manisha.
As if I was going to the US. Come on, CJ, don't rub it in. Anyway.
Man. My last question to you is, generally, if you speak to a lot of forex dealers, they say that this is not about rupee more, that much as it is about the US dollar. And overall, we have, heard commentators globally also say that there is increasing shortage of dollar in emerging markets, and the US dollar index, I mean, that is staring at about a 19-year high at this point of time. Do you expect that globally also US dollar will continue to see the strength that we have seen over the past 6 to 7 months?
Oh, well, that's quite a possibility. I mean, as you mentioned, 19-year highs on the US dollar index, and the fact that you're looking at higher interest rates, rollback in case of liquidity is the reason FIIs also are stepping out. And yes, it's not just the Indian rupee, but yes, if you look at this year until now, rupee is one of the worst performing currencies within Asia.
Wow.
We usually look to Chinese yuan and the Philippines and Malaysian ringgit, Indonesian rupiah, even when you compare your own currency within Asia, and we have underperformed all of these currencies. Clearly, when you look at other currencies like Turkish lira or Russian ruble, Korean won, they have declined even more. But within Asia itself, rupee clearly does not seem to be standing so tall. One, yes, the strength in US dollar, as you mentioned, and with the kind of outflows that we've seen from overall Asia also seem to be impacting. We're not in this alone, but we really seem to be catching up towards the downside here.
Well, thank you, Manisha. That was great. A lot of great insights, and probably not 84, Santo, but at least it seems like the rupee is moving towards the 80, 81 mark against the US dollar, and we'll be keeping a close eye on that. Thank you so much, Manisha.
Well, CJ, it's also that at this point in time, it seems more like a vicious cycle that Manisha was pointing out. But if, let us say, already we are seeing some bit of a slowdown in FI selling, right? And if crude prices cool down further, probably there could be some relief to the rupee, and the situation might not get as bad as it was in 2013.
Yeah, I think, Santo, the only difference I think this time around is with the fact that rupee is hitting record low is the sentiment. I mean, this time around 9 years ago almost, in 2013, you had headlines in newspapers to business channels to national channels about the rupee hitting record low, because at that point of time India was among the fragile 5, right? But this time around, India is probably one of the strongest economies in the emerging market basket. You had at one point of time literally $650 billion of forex reserves. So clearly, I think India's guard or defense against this sort of outflow and the rupee, breakdown in rupee is clearly much better than we had almost 9 years ago. And I think that is why you are not seeing the sort of fear factor that you were mentioning that the equity market seems to have not been displaying.
Well, what else do we have to keep an eye out for, CJ?
Well, Santo, the US personal spending data for May will come out later this evening, and I think that will be a very critical data point to look at. It will most likely dictate how the US markets trade, because it will give an insight on how the consumers are doing at this point of time. We recently had data coming out that the US consumer confidence has hit almost record lows. So clearly, we will have to see how this data point fares out. Tomorrow morning, the Asian markets will react to the Chinese manufacturing data, the second largest economy, a critical data point. So that will be very crucial for the market to watch out for. And at home, the June auto sales data will come out. We spoke about it earlier in the show. It will be very interesting to see how the month-on-month change has been on June. If you look at some of the brokerages' commentary, according to them, the dealer checks indicate that there has been improvement in demand, but we will have to wait and watch the actual numbers, whether that is reflecting in the numbers at this point of time or not.
Well, with that, it's a wrap on this edition of Markets with Santo and CJ. Thank you for watching. Do share your comments in the feedback section below.
And as usual, follow us on the social media links at the bottom of your screen. And for rest of your financial news, stay tuned to Moneycontrol.com and download the Moneycontrol app. We'll catch you again live 9 a.m. tomorrow morning.